Today is July 21st. It's now 9:41. Today's talk is, as you could have guessed, about investing. So I'm taking a little bit of a detour with my own investments. So what I am keen on is large returns and minimal risk. Now, with any kind of investment strategy, you have to be willing for somewhat of a downside exposure. What is your downside exposure when you are investing in a stock? How much are you willing to lose before you start to panic? Now, first and foremost, any money that you put in the stock market, you need to be perfectly okay with losing. Meaning, if we hit a recession, if Joe Biden dies, if, COVID strikes again, the market is going to react very violently to any kind of investment because of fear that the economy is going to be unstable. So with that, you could expect some kind of downside, dramatic downside, I might add, to any kind of investment. So you need to be able to put certain things in place to protect yourself in case of any future downside. So a company that really interests me is a technology stock called NVDA, ticker symbol NVDA. Now, this company has run up drastically this year from right around $130 all the way up to where it sits today at $450. If you look, that's like a 300% gain. And there's still much more room to go. This is a company that only a couple years ago was at $800 and did a split where they issued for every one share, you got 4 shares, I believe the split was. So, in my opinion, there's definitely more upside. This is a company that would have been at the $800 level, again, in my opinion, if we didn't hit COVID. COVID, tore through the entire financial industry, and every company, even if they had great numbers, still sold off. Now that we're out of that, we could expect some more upside when it comes to certain names. So the play that I'm going to tell you is something that I'm actually doing in my account, and you're more than welcome to try to follow along. So I went out today and I bought a $600 strike call on the NVIDIA out until December. Now what that does is it allows me to buy 100 shares of NVIDIA stock at a fixed price of $600 from now until December. Stock today is $450. So there's about $150 that the stock needs to go up in order for my call to be what's called in the money. Now, a option is comprised of two fundamental ways of, displaying value. There's what's called intrinsic value, and then there's called time value. So my call, being $150 away from the $600 strike, is comprised of only time value. Now, anything can happen with time. Stock could go to $1,000. Stock could go to $0. But being that this is a company that has over $1 trillion invested into it, higher than likely chance the stock's going up than to $0. So I believe that there's a very good chance that between now and December that this stock will go to 600. Or if not 600, it'll get pretty damn close. I mean, recently it was up as high as 480. It sold off yesterday, which is great. It opened up a buying opportunity for people like me who want a lower price for a higher return. So I saw my opportunity today. I took it. That $600 call out to December cost me $1,900. Now, you could say, well, Joe, what if you don't want to buy 100 shares at $600? I mean, that's a huge investment. That's nearly $60,000 that you would have to buy the stock. The beautiful thing about options is you never actually have to own the stock. They will go up and down based on how close the stock price is to your strike price. So as the stock goes up, even if it goes to $4.90, that call is going to appreciate in value because now it's closer to $600 than where I bought it at $450, and there's still significant amount of time until expiration out in December. So that call, if that stock goes anywhere near 500, 550, that call, depending on when it goes there, if it goes there within the next month or two, that call is going to explode in value. We're talking $4,000-$5,000 minimum on that call. Now, again, I paid $1,900, so I'm looking at roughly 100% gain. But it's not as simple as that. You have to factor in all the other noise in the financial markets because it all plays a factor on the financial market as a whole. So we have a president, we have a new, voting season coming up next year. We have interest rate concerns, and more pressing to the chip sector, we have earnings coming up, which affects all chip companies, even if they're not the ones reporting. So for instance, on August 1st, Advanced Micron Devices will be reporting earnings. Now, they are not NVDA, but if they do good, NVIDIA will appreciate because NVIDIA is top dog, basically. So if any of the if any of the smaller companies are doing well, then you could bet your ass that, the Gucci of chip companies is going to be doing well. But to the reverse side of that, if those companies report poorly, then NVIDIA is also going to go down with them. Maybe not to the extent of how far they go down, but there will be some downward price movement for NVIDIA. Now, $1,900, I don't know about you, but $1,900 to me is a lot of fucking money, especially to have into an option on a stock that, is nowhere near the strike price that, it needs to be for that option to really explode in value. So you could say, well, Joe, that's, very risky. And I would say, you know what? If I left it naked, meaning I just bought the call, then yes, it is risky. I mean, either way, it's risky, but there are ways to minimize the amount of risk. And that would be to sell a call against my long call. So what I plan to do, I haven't done it yet, but I plan to do later on this afternoon. Right now, the stock market is going up. NVIDIA is up 2 points. I'm hoping that NVIDIA goes up much higher. If NVIDIA goes up 10 points throughout today, all of the calls for every month are going to go up in value, which is great for me because now my long call out to December will be worth, let's say, between 2,000 and 2,100, depending upon how much it goes up, the stock that is. But also the call that I want to sell in September, that right now, if I sold it right this very second, last I checked, again, I'm driving, so I don't know if the stock's up, down, left, or right, but last I checked, stock was up. That call was selling for about $600. So I could sell the September $600 call, which basically says anybody can have the right to buy 600 shares of NVIDIA off of me at 600 for now until September. And they will pay me $600 today for that right without me ever owning the stock. So now I take that $600 in to minimize the risk to my initial investment. My initial investment of $1,900 is now only an investment of $1,300 because I took in 6. I paid 19, I took in 6, so 19 minus 6 is 13. 1,300 would be my risk. Now, if earnings come out good, which I'm hoping for and I expect them to, all NVIDIA will, go up and appreciate in value. Do I think for a monocle of a second that there's an opportunity for NVIDIA to go up 150 points in about a month? I don't. But then again, it is a little longer than a month. It's about 60 days. I still don't. Even if numbers come out well, and granted, NVIDIA is a big company, 10%, if that stock goes up 10%, that's $40. So in order for that stock to go up 150 points, I need it to go up roughly, let's see here, 20, 30. It needs to go up like almost 40%. I don't think it has the power to do that, even if numbers come out, because there's a lot of other, things going on in the financial economy that is going to weigh on the stock. Plus, people are going to be looking to take profits off the table. It's only natural. So, assuming earnings come out well, I don't think by September it's going to hit 600. So, what would happen in September when that call that I sold for 600 goes up for expiration? It would expire worthless as long as the stock's not at 600. So stock's not at 600, that call expires worthless. Whoever thinks the stock's going to be at 700 by September turns out to be an idiot, but they already paid me, so who gives a damn? I got $600. My cost basis is now $1,300 for my call that's still in play out to December. If we turn that around and we say, okay, well, let's say they miss on earnings. What happens then? Well, they miss on numbers, the stock will come down, which is going to slaughter my September call that I sold, which is a good thing because we want it to expire worthless. And it will go down much harder than my December call because there's a lot less days from now till September than there is from now till December. So hypothetically, stock goes down, September call gets smashed. I then have the opportunity to buy it off at a fraction of what I originally took in. So originally I sold it for $600, right? So then stock goes down, I'm able to then buy it back and get rid of it for, if it's selling at 200, I could buy it off for 200 and keep the difference. So now I made $400 and my cost basis came down to $1,500 instead of $1,900. I took in 6 originally, but I laid out 2 to get rid of it and kept the 4. So now my cost basis is only $1,500. At that point, I could wait until the stock goes up again a little bit longer, because even if it for whatever reason goes down for earnings, it's going to come back up. It's just a matter of time, because the company is in everything. I mean, literally. So in my view, I have a great opportunity to capitalize on speculation on the stock, either which way. So the play is buy the long call out till December, sell the short call out to September, because I don't think that it's going to 600 by September. Take in the premium of 600 or whatever it is. I haven't sold it yet, but I'm hoping the stock of NVIDIA goes up to where that call goes, $700-800. So when I sell it, I take in far more than 600. I take in whatever it's going for. So let's just call it 700-800. Take whatever that premium is and deduct it from the money that I spent to bring my cost basis down, and see where the stock goes. That is my way of doing it. Now, there is a financial advisor that knows options very well, who I've learned a lot from, that would possibly consider going and adding another leg to my strategy, which could be a wise move if you believe in the narrative that the stock's going to go down. So there are options out there called puts, what basically gives you the right to sell the stock no matter where it is at a fixed price till a set expiration date. So what they would do is they would buy the long call, sell the short call, use the premium from the short call to then go ahead and buy a put on the stock underneath where it's actively trading, to where the put is paid for by the short call. So in essence, if the stock goes down, the short call gets smashed, as well as the long call will lose value. The one out to December that we paid 19 for will probably go down to 14, right? But that put will skyrocket because the stock that put becomes more valuable, because now you have the right to sell the stock from now until expiration date at that fixed price, no matter if the stock goes to zero. So as it goes down, that put's value goes up. So that's another way to play it. But personally, for me, every strategy has to fit the investment, has to fit the goals of the investor. There's many factors to play in here. And then you also have to look at the company, right? I mean, if it's a shit company, then it would make sense to, add all those legs in hopes that it goes down. Quite frankly, I don't anticipate it to go down. And if it does go down, I will capitalize off of the short call. I feel like the put is almost like overkill, because if the stock goes up, then the money that I took in from the short call gets wiped out because I bought that put. And since I have until December, I have more than enough time for the stock to recover, assuming it misses on numbers from now until December. Earnings come out August 23rd. So, within a month or so, Christmas season's coming up, holidays, everybody's buying, market's booming. I really gotta believe that even if NVIDIA misses on numbers, that it will recover, because the company makes hundreds of billions of dollars every year, and no company is perfect. I mean, look at Netflix. Netflix just missed on earnings. Their subscriber growth was there. That's what Wall Street wanted. Wall Street wanted to see, an additional 2 million subscribers that are paying for the service. They came in at an additional 5 million. That was there. But their revenue wasn't exactly what Wall Street wanted, so company sold off. What it do? It sold off roughly 30, 40 points. If you look at Netflix today, it's probably back up. Maybe not to where it was, but it's on its way. So it doesn't take long for a company to recover. And that's why, even if you don't do my strategy of the option and you just buy the stock, if you're a long-term investor and you're not going to watch it as I am, you have no business buying options, because options are something that requires you to pay more attention to it. Because there's many different ways that you could capitalize, but also many different ways that you could lose. And we're not here investing our money so that we can lose. So, all in all, I believe that NVIDIA is going to do well. I mean, they've done well the past several quarters. That's not, past success is not always an indicator of future success, But, you know, they're just growing so rapidly. I really would be shocked if they missed. And even if they do miss, it's not the end of the world. I have until December. My cost basis is $1,300. NVDA will go up fucking 10 points, 15 points in a day. Even if the stock doesn't go anywhere near 600. Right now, I bought that call, stock was 450. It misses on numbers, goes down to 400. Let's say over the course of the next month after earnings, it goes back up to 450. While it's going back up to 450, that call out to December is regaining the value that it lost. So if I could get it back to 1900, my cost basis is only 1300 because I sold the short call. So if I sell it at 1900, I win. You know, so as long as you follow the play, it makes sense. And it's not as much of a risk. And that's the point of this whole conversation. You know, there are ways that you can manipulate the market by using certain tools and hedging and strategies to better increase the income that you derive from certain investment vehicles while minimizing your risk exposure. And with that, I got to go to work. But like always, happy investing, and I hope everybody does very well. Take care.